So I'll make this for you the higher time frame. I'll just kind of give you my perspective on it, which is just regurgitated information from um, JME, ZUSI, ICT. Um, but nevertheless, I mean, sometimes it helps when you get a different perspective. Um, First off, it starts here for me, for everybody, I would say. So economic calendar, you want to make sure you're trading within a proper day. So avoiding bank holidays, avoiding certain days here outlined. Um, you want to trade within your session of interest, whatever that may be. And then the intermarket relationship. Um, this is most important because you want to make sure NQ and specifically ES are moving in the same manner, um, taking the same highs, taking the same lows on the higher time frame. YM, not so much. It's always going to be a little out of order compared to ES and NQ. So really, NQ and ES, you want to make sure there's no significant SMT on both sides of the market, and that they're moving in tandem, at least during your session of interest or during that week. If they are moving in opposite directions, is a lower probability. If they're congruent and moving together, it's higher probability. So if you look at yesterday, we have NQ, ES, and YM. And what you can see is they're all relatively the same. You have Asia, 930, distribute. If we look at ES, you have Asia, 930, distribute. YM, Asia, 930, distribute. And the difference is we took out London high and Asia high with the 930 opening. With NQ, with ES we did not. So that right there tells you you should be pretty bearish for the day, because that's a significant SMT. ES and YM don't do that. NQ does. We see SD, and then both markets move together, taking sell side objectives. So the intermarket relationship here was good on Friday, and then you have the SMT, which is very obvious when the markets are moving together. When you have the markets moving in the same manner, and then you have an SMT like up here, that's super obvious. And that makes it high probability. And that's something you can see not only on the minute chart, but specifically on the hourly chart. So if you look at it at the beginning of the day, Asia, everything looks kind of the same, and then 930 opens, and you get that significant run higher. And if you're looking at the other charts, the other indices, which is recommended, then obviously you see Asia's still intact, and at that point, once this hourly candle takes out that high and the others don't, then you want to zoom in. Then you want to zoom in and try and find your trade. Okay, so as far as higher time frame protocol, higher time frame narrative, this is it here. So first is order flow. You want to use the hourly chart. You want to use order blocks, fair value gaps, use the left side of the curve to measure the order flow. If there's no left side of the curve, use the right side of the curve. So basically, I'm going to go to the hourly chart, and for instance, on Thursday, it was super clean and super obvious. So at the beginning of the week, we were using new week opening gap. Okay, we got above that. So if you look at it from this perspective at the beginning of the week, let's just go here. So at the beginning of the week, once this candle closes here, you would be bullish because this is the array. This is the discount array you're going to be using. This new week opening gap. And this is a market maker model. So you use it the same way as you use the lower time frame chart. You just use it on the hourly chart or the daily chart. Okay? So you want to use the closest arrays to price on the opposite side of the curve. Okay, so you have your low here at 6 p.m. on Sunday open. You could classify that as your SMR. So you want to use price action that is to the left over here. Okay, so everything over here would be the left side of the curve, and that's what you would want to drag across and use to determine the order flow on the right side of the curve. And a really good starting point for the week is a new week opening gap if you have one. If not, what else do you have? You have this gap. You have this large fair value gap that's been used as resistance. So when it gets turned into support, you want to see that function as support on the higher time frame. And that becomes a higher time frame POI to take longs or to take shorts. So let's go ahead and let this play out. And as you can see, we get above it here. Okay, so once we close above it here, with the 12 p.m. candle on Monday, price comes back into it, tests it as support, and we run higher. So that confirms the bullish order flow, takes out the market maker model, and the trade's over. Then you look for another market maker model. So at this point we move to the current side of the curve, which is what you do when there is no side of the curve. So like I said here, if there's no left side of the curve, use the right side of the curve. So once you're above the original consolidation of the market maker model, you have to use the current side of the curve. So in this case, what would you use? What's closest to price? Well, you have an order block. You have fair value gaps here. Sorry. Just make that discount array. So you have an order block there, fair value gaps here. You would want to see those function as support. And remember, this is the original consolidation. We're above that, so we don't have anything on the left side of the curve to reference, at least on the hourly chart. If you were going to go to a lower time frame, it would be a different story. So we close down below that. That's our first sign that order flow is changing. Okay, and then price goes lower. So once we close below these order blocks, order flows changed. You have these order blocks. So remember, I like to use PD arrays that have been used as support or resistance. So technically, I wouldn't slam it up into this order block immediately because it's not been used as support yet. So maybe you drop it back down into this one because we've ran above it, we've came back down and tested it, we've ran above it again, and now we've closed down below it. So you want to see this function as resistance. Okay? And we get down below it and we come back up and use it as resistance and we sell off. So there's a trade in there. Tuesday morning, there's a short that you can take lower. And now, what do we have? We have another market maker model setting up, a market maker sell model. So we have the original consolidation down here. OC. And now we look to the left side of the curve for arrays that have been used as support to function as resistance for the sell model. So we have that. What else do we have? We have a fair value gap. It's not been used as support. We have this order block that has been used as support, at least a high. So what you could do is tighten this up or zoom in on a lower time frame and find a 15-minute or a lower time frame array because that's pretty large. Or just go down a little further and find something that's been used. So maybe this order block, we haven't really tested it. How about this one? So we could use this. Okay. Drop lower, come higher, come in to test it, and run higher. So you could use that, but it's not really anything, technically speaking, because it's a down close candle, an up close candle, a down close candle. So your order block would be here, and this wouldn't be anything. So what you would do is use these up close candles, which are breakers, which are bearish order blocks here, that get inverted and used as support. And now you want to see these function as resistance over here. Okay, so it's technically a breaker. So it's an old bullish breaker turned into a bearish breaker. Okay. The key point is to find an array that gets traded through, retested as support, opposite side of the curve, trades through it. You want to see it act as resistance. Let's play it out. You can see price comes up into it, sells off in Asia. And we have new week opening gap here. And then through here, there's really nothing. There's really nothing to play off of other than that new week opening gap. Maybe that. Maybe this. So let's just keep playing price out here. Okay. So we run up and then we drop lower into the new week opening gap. So we have the buy model, we have the sell model. The sell model doesn't complete. And then we start to shift. We start to have a change in the state of delivery here. Okay. What I mean by that is you can just visually see price not respecting these arrays anymore. Okay, this one, which we used for resistance, dropped lower, creating a new leg, ran higher, dropped lower, running higher again. So now we might be starting another buy model. Okay. And then this is where you come to Thursday, and there's actually in real time, there's a significant SMT there. So there's a significant SMT here on the daily lows, and that's a sign that it's a bullish SMT because ES takes out this daily low, NQ does not. So ES completes the sell model, NQ does not, and then we revert higher, changing the state of delivery, okay, by not respecting these PD arrays. But let me clean this back up so it's easier to see. And then once we wick down below here, that's SMT, we run higher, we want to look to the new left side of the curve. And the new market maker model that's forming, which is here. Okay, original consolidation up here. Smart money reversal here on the higher time frame. It's a daily SMT. So we're looking at a 1 hour market maker model now. And what do we have over here on the left side of the curve? We have these fair value gaps that act as resistance, dropping price lower, creating SMT. So getting above this is a CSD. Getting above this is a CSD. Okay. This is the SMR. So anything to the left we want to use to determine the order flow on the right side of the curve. So you have an order block. You have a, well, it would turn to a bullish order block. You have a breaker. So you wouldn't use the down close candle. You would use the up close candle here as a breaker. Okay. So we get above that, that would be a breaker. You have this fair value gaps here. A breaker inside of a fair value gap, so you would use this whole entire range. Once we close above, we're bullish. Okay, so here and then here, we've now changed order flow to bullish, and now we're looking to complete this market maker model. So you can leave it like that, you can tighten it up here on this breaker, and then this becomes your POI for your entries on the lower time frame. Okay, so order flow, determining it, drawing liquidity, point of interest. So your point of interest is what I'm talking about now, is going to be here. Okay, it's going to be here on the left side of the curve. So I'm not going to use a point of interest on the right side of the curve, I'm going to use it on the left side of the curve. And when price comes back down into that, I'm going to look for longs. So it's also the invalidation level. So if price was to roll over and close down below this and use it as resistance, that's the invalidation level. So then we would go from looking for a buy model to another sell model. And that's what happens. So we roll lower, and then we open up, create SMT on the low, and then take the high. So we roll over here during the point of interest, time of interest, which is New York Open. We drop lower into um, the point of interest, being these inverted fair value gaps, which have become now a discount array. So, all this, I don't trade any of that. I trade New York. So, um, it's a perfect display of accumulation, manipulation, distribution. Okay? And that's really what you look for anyway. Accumulation, manipulation, distribution. Accumulation, manipulation, distribution. That's what you look for. This one doesn't. Obviously, they don't always do it. You know what I mean? But that's what these time cycles are for. You want to see accumulation, you want to see manipulation during that one, and you want to see distribution. During New York, you always want to look for an accumulation here, a manipulation here at 8:30 to 10, and then a distribution cycle between 10 and 11:30, and that's it. That's the best trading window. So, what we can look at, we're at the point of interest, and then 9:30 opens. 9:30 opens, drops lower, taking out the liquidity here, the time-based liquidity, forming SMT. So we drop lower, SMT forms between these lows. We're bullish higher time frame. We're bullish intraday. You have SMT here. You have SMT here. And then more importantly, you have SMT here at the reversal. So this becomes your SMR. And then you're waiting for CSD to get long and complete the market maker model. And the first market maker model would be here. And the second one would be here at the hourly high. And we're in the point of interest from the hourly time frame. We've determined bullish order flow. And this is the change in the state of delivery, that fair value gap. We close above, change in the state of delivery there. And then you can take longs. Stop can go here, stop can go here. Okay? And it completes the model. So hopefully that helps. Let me know if you have any questions.